My name is Dave Wilhelm. I'm a professor in the Business Administration Department at Wake Technical Community College in Raleigh, North Carolina. This video is one in a series so that my online students can get pretty much the same information as my seated students. This particular video is on cash discounts. We'll talk a little bit about the relationship between business customers and suppliers, cash discount terminology, a couple examples, and then a brief exercise for you to do if you wish. So long-term business relationships, these are not adversarial, these are partnerships. We have a supplier who supplies things to a customer for money, and a customer who relies on the material from the supplier for their ongoing business. So it's a collaborative relationship, not an adversarial relationship. Two ways that the buyer and the seller can help each other out. The seller can help the buyer by something called trade credit. It's the easiest way for a buyer to get a short-term loan. And the seller simply gives the buyer, customer, a little extra time to pay. If normal requirements were to pay within 30 days, maybe they get 60 or 90 days for a couple orders. The supplier does want to keep the customer in business. The other alternative is a cash discount. And this is where the buyer offers a discount. Nope, this is where the seller offers a discount to the buyer in order to encourage them to pay their bill earlier. A couple typical cash discounts would be 310 net 30. And what this describes is the seller will give the buyer a 3% discount if they pay within 10 days. If they do not elect to take advantage of this, the bill is due within 30 days. And then there may typically be a charge for later payment. 220 net 45, you've probably figured this out by now. 2% discount if paid within 20 days, and otherwise it's due within 45 days. These are typical cash discount examples. Here is the 310 net 30 again, and the diagram shows us that from the delivery date or the invoice date, whatever's agreed upon, if the payment is made within 10 days, there's a 3% early reward. Otherwise, the customer has another 20 days to pay the bill. So what is the annual percentage rate of this? How do we determine that? I think the easiest way to do that is don't think of it as a 3% reward by paying early. Think of it as a 3% penalty for paying late. And then it kind of makes sense, at least to me. So if we have a 3% penalty for a period of 20 days, what is the annual percentage rate? To calculate that, we take the percentage rate, of course, and then we multiply it by 360 days over 20 days. And that is simply the number of 20-day periods in a year, or 18. Multiply the two, and you get 54% per year annual percentage rate. Why would a seller offer a 54% interest rate? Well, for cash flow. The seller wants to get that cash in there. The three major financial statements of a business are typically earnings statement, also called profit and loss, income statement, and the balance sheet and the cash flow. For especially small businesses, probably cash flow is the most important measure of how a business is doing. You can live with negative earnings for a while. An ugly balance sheet's not good, but it doesn't shut you down. If you can't pay your bills, your employees won't come to work, the lights won't come on, and so forth. So cash flow is very important. And it's not for a whole year. It's for a fairly small period of time. And if you compare it to credit card charges, a 2 or 3% discount rate is pretty reasonable, especially since we're typically talking about large amounts for business-to-business transactions. The 220 net 45, same diagram. Once again, instead of thinking of it as a 2% early reward, think of it as a 2% late penalty. Effective APR is 2% times 360 over 25, and that's just the number of 25-day periods in a year, and that comes out to about 29% per year. Notice that the annual percentage rate calculation actually does not depend on the discount time. It depends on the time between the early payment and the late payment. Here's an exercise for you. I hope you didn't notice that little flash there. Exercise, what does 2.5/15 net 30 mean? Think about it for a second. 5, 4, 3, 2, 1. Means a 2.5% cash discount if paid within 15 days. Otherwise, it's due in 30 days. The calculation, 2.5% times 360 over 15. And that's the number of 15-day periods in a year, which is 24. Multiply those out, the annual percentage rate is 60% per year. That's it for cash discounts. I hope this helped. If you have any questions, feel free to email me.